You might be hearing a lot about private credit and wondering if it's right for you. To help you decide, I'm going to compare private credit funds against public credit funds, otherwise known as publicly traded mutual funds. Hi, I'm Mr. Retirement, and I want you to get more income, pay less in taxes, and avoid big retirement mistakes. Subscribe to my channel, Mr. Retirement, and learn how to get the most out of your retirement. To make this comparison, I compare the Fidelity Private Credit Fund against a similar Fidelity mutual fund called Strategic Income. Now, there's a whole lot of info you should read in something called a prospectus when you're trying to decide between two investments. And I chose Fidelity as a comparison because they have a lot of publicly available material on their website. It's not because I like or dislike them. And I'm not telling you to invest or not invest in either of these. But a comparison of something you know, which are mutual funds, to something you're probably less familiar with, private credit funds, is a good way to learn about that new thing. The private credit fund has a 1.25% annual expense compared to the mutual fund at 0.66%, roughly half. The private fund also has an incentive fee of 12.5% above a 5% hurdle. So if the fund does 9%, then you take that 4% that's above the hurdle, you multiply it by 12.5%, and there is then a 0.5% incentive fee. The public mutual fund doesn't have those incentive fees. The private credit fund also uses leverage, which means they borrow money to buy more investments. They would generally borrow $1 for every $1 invested, but they could go up to a max of $2 borrowed for every $1 invested. This leverage could increase the returns because they hope the interest they pay on the money they borrow is less than the interest the fund gets on its investments. But it could also increase the risk because when the value of the investments go down, the amount it owes is still the same, and that magnifies both the returns on the upside and the risk on the downside. The public mutual fund does not use any leverage. With the mutual fund, you can sell and get your money anytime you want. Of course, the price probably fluctuates up and down every day. With the private fund, the price is supposed to be more stable, but you're only allowed to sell once every 3 months. And if you ask for all your money out at once, you might not be able to get it all out that quarter. The best way to understand private credit is to compare it to public mutual funds. And when you look at the differences in cost, the differences in flexibility, the differences in how the prices fluctuate, how you can get your money out, and the difference in leverage, you can learn enough to make the right choice for you. Of course, your investments is only one piece of the retirement puzzle. Check out how to retire with confidence using a safety-first approach. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.